Welcome to another edition of Strategic Financial Management. In today's class, we shall continue with the capital budget, right? Now, in today's class we'll look at this illustration 2 of our material. I believe that many of you have gotten your material, right, as of today. Now, let's go. Now, first, let's quickly read the required first. So that we need to understand the required before we move ahead. Compute the appropriate cost of capital that AKPLC should use to appraise the project using the asset beta of the identified listed company rather than what? The existing WACC. Something should come to your mind even without reading the question. Something should come to your mind now. That the question says compute the appropriate cost of capital. When you say appropriate cost of capital, you should know that definitely this company want to what? Diversify, or this company want to what? Diversify. They say rather than the existing WACC, you should use the appropriate cost of capital. Right? Now the next one is now your final cost of capital should be rounded up to the nearest whole number. Say any assumption you made during that period. Compute the NPV and the modified internal rate of return. State whether the project should be accepted or what? Not. This is total marks, Abi. Now, when you look at this total marks, is 30 marks. This is one of the compulsory question. Now, having read the required, now let's quickly go to the body of the, okay. Now, AKPLC is a listed company, right? I will keep these people that are waiting, I will keep them waiting, right? I will keep them waiting. That would be their punishment, right? We in what is it called? In Nigeria, we take free things. We take free things for levity, right? Because after all, I'm not paying for it, right? So they should stay at the waiting room. They should stay there, right? I will leave them. They will be there for 5 minutes. Thank you. Now, a AKPLC is a company listed on the Nigerian Stock Exchange. It is involved in property development and sales. And what? And sales. Right? The company currently imports more than 60% of its cement. Right? Of its what? Of its cement requirements. Class. The company currently imports more than 60% of its cement requirements. At a recent meeting of the board of directors, a decision was taken to establish a division for the production of cement in Ore, Ondo State. This company is currently importing 60% of its cement requirements, right? They now say, oh, the board now decide that we want to establish a production, we want to establish the division for the production of cement in Ore, which is Ondo State. Now, if the division is set up and the cement production goes ahead, profit from the division will be taxed at AKPLC and the standard tax assessment practice, right? Standard and the okay, where am I? And the standard, sorry about that, please. And the standard tax assessment practice for planning purposes, right? For planning purposes, it was decided that the financial viability of the project over the next 5 years should be determined, right? The financial viability. So if we want to go by that, what will be the financial viability of that project? Now, the sum of 2 billion will be what? Will be required. The sum of, for the project, the sum of 2 billion will be what? Will be what? Will be required. The sum of 500 million will be spent to acquire an existing factory considered suitable for the project. They said, oh, they will, out of this 2 billion, they will use 500 million to purchase an existing factory equipment, right, that they will use for this project, which is relevant, right? Now, the balance of 1.5 billion will be applied for the procurement and installation of essential plant and equipment. So, which means that their initial cost total is 2 billion for this project. Tax allowance can be claimed on plant and equipment at a uniform amount over 5 years with new tax scrap value. They said, oh, on this equipment that you want to buy for 2 billion, there will be what? There will be a tax allowance. So definitely there will be capital allowance and as well as tax saving in this question, and over the what? 5 years. And they said there is no what? There is no scrap value, which means that at the end of the project there will not be terminal value. Another name for scrap value could be terminal value, right? Now, a total of 20 million now has been spent on various surveys: market, technical, financial, to date of which 10 million has been paid. The balance of 10 million is due for payment at the end of the year one. Class, this 20 million here that has been spent on various surveys, is it a relevant cost? I need to establish that. Is it a relevant cost?
No, sir.
It's irrelevant.
Okay, is it
It's a
irrelevant
sunk
cost? Because,
cost.
thank you, because it
No,
is a
it's a sunk
sunk
cost.
cost, right? It has been spent for survey, right? It is not a relevant cost, right? It is not a relevant cost. Now, let's move on. Production of cement for the next 5 years is projected as follows. This is the projected production: 500,000 units, 600,000 units, 800,000, and so on, right? Now, a bag of cement sells currently for what? 2,000 naira in the open market, which means that one bag of this cement will cost 22,000 naira per bag, right? Now, the price is expected to increase at the rate of what? 5% per annum, which means that this price, the selling price, is expected to increase by what? 5%, which is 1.5%, right? Or you still use that your primary school or secondary school approach. You first of all charge 5% on 2,000. Now add it together to give you the same thing. Is that not so? Now, variable cost. Now, this is it. Variable cost is now 800 naira. 800 naira per bag. Madam Linda, thank you for that. I didn't actually check it. So immediately they send the question to me. I quickly put it in my what is it called, in my notes, right? I didn't even solve. I've not even solved this question. Immediately someone send it, I'll say, oh, we have to do it, right? Now, variable cost is now 800 naira per bag, right? Now, this will increase at the rate of what? 4% per annum. All these ones are just simple. 4% per annum. Is that not so? That is 1 point what? Still the same thing. It will be 104, 1.04. Is that not so? Right? Now, fixed cost will be 50 million at the current price. Right? At the current price. But will rise by what? 5%. If they see something is at the current price, is it a real cost or a nominal cost? Is it a real cost or a nominal cost? I need someone from this class. When they say a cost is at the real cost, right? Is at the current price, rather. Is at the current price, class. So that particular cost, is it a real cost or a money cost? Hello?
It is a record.
Thank you. It is a
Record.
real cost. Thank you. It is a real cost. It is a real cost, right? Thank you. Now, and it will, but we rise by 5%. So once you just rise it by 5%, it becomes what? It becomes money. Is that not so? Now, approved cost of the allocation of 250 million at the current price, approved cost of the allocation at current prices will be 10% per annum. Class, this allocation here of 250, will it be a relevant cost to us? Is it a relevant cost? Class,
It's relevant.
why is it relevant? Comfort. If it is relevant, why? If it is not relevant, why? Hello, Comfort. You said it, the approved cost of the allocation is a relevant cost, but and I asked you, if it is a relevant cost, if the allocation is a relevant cost, why is it a relevant cost?
Hmm. I just feel because actually, if it's allocated to the cost of the business, like it's relevant.
No, no. Go back to the relevant costing. Anything that has to do with allocation or apportionment, it is not relevant. When you are apportioning cost, it is not relevant. When you are allocating a cost, it is not what? It is not relevant. Right? Now, project plant cost 15%. Project plant cost 15% of the financial outlay of 2 billion is to be funded, class. Is to be funded with a loan from a federal government, class. The project costs, which is the cost, right, of the financial outlay of 2 billion. Don't forget that the outlay, the equipment, the initial investment is 2 billion. They now tell you that this 2 billion, oh, if you want to get it, the costs from the federal government, it will be 15%. It will be what? 15. That is the cost of is the cost of debt of that particular word. That is from the federal government. Is that not so? Now, if the federal government is saying if the project plant cost is 15% of the financial outlay, is to be funded with what? With a loan from a what? From a federal government, which means that this 2 billion will be funded by a loan from the what? From the federal government, which is 15%. We will get to adjusted present value, right? We will get there, right? But understand this, that the cost of this is 15% if they want to get it from the what? From the government, right? Now, development bank at a concessionary fixed interest rate. Now, this is when adjusted present value will come to play. Development bank at a concessionary fixed interest rate of 8% payable at the end of each year. Comfort, if you are the project manager of this company, will you go for the federal government cost of 15% and you will now leave the development bank of 8%? Which one will you go for?
Development bank of 8%.
8%, which is below the government
Yes.
one. Is that not so? Now,
Yes.
just everybody should pick it from there. Pick it from there, right? Now, half of the loan will be repaid at the end of the 3 year, while the balance will be paid at the end of 5 years. Don't forget that all this interest it is not a relevant cost in what of a project. Don't forget, it is a committed cost, right? It is a committed cost, right? Does not what? Relevant. Now, don't forget, it will become the cost when we want to determine the cost of debt, right? You will not go for 15%, but you will go for what? For 8%. Now, the project will require the working capital of 10% of annual revenue class, which means that what is working capital is what you use in running the business. Is that also? Now, in the month of January, I use I present 100,000 naira to the management of Next Gen Professional Associates that, oh, this is my working capital. At the end of the 4 months, I will recoup back my investment, right? So, which means that my working capital will be 10% of the what? Of the revenue, which means that when you multiply your selling price times the numbers of bags, when you add your revenue, you now charge 10% to be the what? To be the working capital, right? Which will be disallowed at the beginning of the year. Disallowed means that it will become an outflow at the beginning of the year. Why at year zero, right? It will not be allowed. You will not even use it, right? Now, at year zero, it will be that figure, right? At the end of the period, you do what? You recoup back your what? Your investment. You will see how we will do that. We've done that in our previous class, right? Now, the company uses a current weighted average cost of what? Capital. You can see now the company uses, this is the company weighted average cost of capital, right? This is the company weighted average of what? Weighted average of beta class. Now, the asset beta of the company is 1.2. Class, the asset beta is 1.2. While the equity beta is what? 1.6. Now, there is what we call equity beta. When your beta, let's say when your beta is greater than 1, what is the implication, class? When beta is greater than 1, what is the implication? Class, when a beta is greater than 1, what is the implication? I will call name
Is risk
Aishat.
is
Okay.
Okay, no, Rachel, no. Aishat, are you there? Okay, it's risky, right? It's a risky what? Investment. That stock, that particular stock is risky, right? Now, do you know the higher the risk, the higher the what? The return. Now, the risk free, they give us all the element of CAPM here. Is that also? And the market return. Now, the financial director is of the view, is of the what? Is of the view that that it is not appropriate, class, it is not appropriate to use the existing weighted average cost of capital to appraise the new projects, right? The finance director is of the view that it is not appropriate to use the existing weighted average cost of capital to appraise the new projects. He has identified a listed company which currently produce cement and package food drinks. Class, don't forget that at the beginning of this story, this very simple question, they said this company imports 60% of the cement. Now they now identify a production in Ore, right? Now, if they want to go by that, they have to use an appropriate cost of capital to do that. Then I say, oh, the finance director is of the view that it is not appropriate to use the existing. Yes, because the existing weighted average cost of capital does not include the systematic risk, right? Now, he has identified a list. Don't forget, when you want to diversify. It's not that you are leaving that business. It's not that you are moving into a new business. No, it could be within that particular what axis, right? Now, he has now identified another company that is currently producing cement and packaged what? Food drinks. You can see the diversification, right? Now, the company, the company, the company has the following financial statistics, which means that that other company you have identified, right? That other company that you are what? You have identified. They did not actually tell us the company, right? It was not actually stated that is this so company, but we already know that finance director is not even happy that you should use the existing one because it does not consider systematic risk. Now, the company has the following financial statistic, which means that the other company, right? Now, equity beta is 1.2, right? Debt beta, right? Beta debt is 0.4. Excuse me. Debt to equity ratio. Don't forget, when you have debt to equity ratio like this, 40% will be for what? When you have debt to equity ratio like this, class, when you have debt to equity ratio like this, 40% will be for what? The other percentage will be for what?
40% will be for debt.
Okay. What of the other one? What of equity?
Equity,
The
60%.
what of 60%? Oh, good, interesting.
100%
Okay.
for equity.
You say?
100%
Oh,
for
what is
equity.
100%?
Ah, hmm. Aisha, we will fight. Oh. Hmm. We will fight. When we start our fight, even Samson cannot even separate this fight. Even Rachel. so, so 40 for the debt, right? And 100 for equity. Now, class, pay attention to this part. 60%, class, they have identified another company that is producing cement and packaged foods. Why are they identifying? Because they want that weighted average cost of capital to include the risk, right? Now, 60%, class, the equity beta is given. Is that not so? Now, 60% of the market value of the company is attributable to cement production. Cement production. 60% of the market value of the company is attributable to what? To cement production. Why 40% of the value is attributable to food drinks division, class. Now, the food drink division has equity beta of 1.8. Class, this is logic reasoning, right? Pay attention. The company is into production of cement and the company want to diversify. Now, they now identify one company that is producing both cement and packaged foods. Now, class, the equity beta of both the cement and packaged foods of that company is equals to 1.2. But we don't need the packaged foods. We only need cement because the company is into what? Production of cement. Now, you need to have a portion, a percentage of equity beta for cement. So that is why they now give you that 60% of the market value of the company is attributable to cement. You will now say, let S represent cement. It will be 60% times X plus Y. 40% of the value is attributable to food drinks division. Now, the equity beta for the food drinks is given as 1.8, which means that 40% of 1.8 is for equity beta for food drinks, right? All will be equals to what? Equity beta of 1.2, class. The equity beta of both cement and packaged foods is given together to be 1.2, which means that equity beta is equals to production of cement and packaged fruit. Class, the only thing we need is for cement, but the equity beta given to us, we cannot use it because it is a combination of both cement and packaged fruits. Now, you need to separate, you need to get the one equity beta for what? You need to get the equity beta for the cement. That is why you are given that the 60% of the market value. So let S represent cement. So it will be 60% of X plus why 40% of the value is attributable to food drinks class. Food drinks. 40% of what? 40% of the equity beta for food drinks. Now, the equity beta for the food drinks is what? 1.8. Therefore, it will be 60% of X plus 40% times 1.8 equals to the total of the equity beta so that you can get the equity beta for cement. Class, are we still together? We need to confirm that. Are we still together?
Yes.
Yes, sir.
This last.
Yes, sir. Yes, sir.
Okay, nice one. You can see the way the question is, right? Right. I love this kind of question, right? It's logic reasoning. Yes, it makes sense. Now, the new project is expected to move AKPLC to the target debt to equity ratio of 30%, which means that the other where they are diversifying into the new one class, the new one, right? Now, the last paragraph says that the new project is expected to move AKPLC to the target, which means that this is the level of gearing because of that new project. Oh, their debt to equity ratio for AKPLC, the company, right, will be what? Their level of gearing will be what? 30%, which is debt, 30% of debt, then 100% of equity. Now, the tax rate to be recovered is at credit. To be recovered as credit and is paid in the year the profit is what is being made. You can see in this question now, they did not give us the tax rates for the proxy company when they gave us all these financial statistics. Now, it is part of your assumption that you will state when you are using the same tax rate for the proxy company as well as the what? For the main company, right? It is what? It is allowed. Assumption is allowed in what? In finance. Because when you want to do evaluation of a business, you use input. Your input is based on assumption, macro. Is that not so? So, and that is what is allowed. Right? Now, you can see how we analyze this question. Even without solving this question, you guys are good. Probably we should end the class safe. Is that not so? Should we end the class?
Wickedness.
They play.
No wickedness, Oga. I beg, no vex.
So if this is established, right, we'll move ahead to suggested solution, right? Suggested solution, complete the appropriate cost of capital. Now, what is our first step? We identify the proxy company. Who will do that? They didn't even tell us the proxy company, right? Number one, proxy company. Identify. Okay, let me just put proxy company because it is not the company is not even stated. Proxy company because it's appropriate, right? Proxy company. The other MPV, you'll be the one to do that one. No, I will not do that one. Just this appropriate cost of capital that we saw. So proxy company, right? Now, what is the next step? What is the next step? Step 2. Class, what is the next step? Class, appropriate cost of capital.
Calculate
I
asset.
know, Samson, you want to check your note.
Calculate asset better.
Calculate what?
Asset better.
asset beta, right? Now, don't forget that the asset beta given to us here, the asset beta given to us, where is asset beta? Is asset beta? Where is asset beta? Oh, what are we given? We are given what? Equity beta. Is that not so? There should be a place that they give us asset beta now. What happened? Okay.
You have to compute the asset beta now.
Okay, that's fine. Okay, that's fine. So, what is the formula? What is the formula for calculating asset beta? Quickly. What is the formula? Quickly. Now don't
Beta
forget,
equity.
Abby.
Beta equity multiplied by value of equity.
Okay. So now, we want to determine assets beta, right? Which is geared the gear or on gear, right? By removing the what? Financial risk of the what? Of the project company. Right? Of the what? Of the project company. Okay. Okay, by removing the what? The financial risk of the what? Of the project company, right? Now, what is our formula? What is our formula, class? Quickly. Class, so what is the formula?
Beta equity times value of
Beta
equity,
equity.
value of equity plus value of debt equal bracket 1 plus 2.
Okay, let me look for my formula where I can copy. Sharp. Instead of writing it, right? Just a minute. Okay. Let me look for where I can copy it out sharp so we can move ahead. Okay. So this is it. Right? So this is the formula. Asset beta. Right? Now, better debt. Is better debt given in this question? Better debt for the project company. Oh, better debt
Yes.
is given. Is that not so? 0. What? 0.4. Don't forget that when the better debt of the project company is not given, all this side automatically becomes what? Class, all this side becomes what? Automatically becomes what?
There.
Becomes what?
Zero.
Zero. God
Zero.
bless you. Yeah, thank you. So now the better debt is given already. Is that not so? Now, class, the VE, which is BE, now the BE is equity beta. Is that not so? Class, the BE is equity beta. But the equity beta given to us in this question is for both cement and packaged fruits. We need to get the one for cement. Class, that is why they gave you 60% of it will be attributable to cement. While the other one, the 40%, will be for the fruit drinks. Then everything will be equals to what? 1.2. Class. Are we together? 1 point what? 1.2. You can see as SFM is very simple. Right? Now, just the next thing is for you to get calculate BE, right? You get the BE. Is that also? You get the BE for what? For the cement. Is that also for what? For cement production. Because what we were given is combination, right? Now, don't forget that it will be equals to cement plus food packaging. Packaging. Is it packaging or package? Package food package. Class, your equity beta of 1.2, which means that the total of this is 1.2. Class, let me quickly go back. 1.2, is that also? Then 60% is attributable to what? Cement. Let S represent cement. Why 40% is attributable to what? And you are given the food division as a higher equity of what? 1.8. Class, is that also? As what? 1.8. So now, therefore, let's quickly go back. 60% will be for what? Will be for cement. Is that also? Let X represent cement. Equity beta for cement. Right? Equity beta for what? Equity beta for cement. Let me finish. Equity beta for what? Equity beta for what? Cement. Right? Now, therefore, 1.2 is equals to, now we are given that 60% is for what? Is for the production of cement. 60%. 60% of what? We were not given, right? That is why we say make X there. So 60%, that is 0.6 times X plus, you can see 60% times what? Times X plus the packaged foods. Now let's quickly go back. We're told that the food drinks has 40%. And 40% of what? The food drink division has a higher equity of what? 1.8 is higher. So which means that you need to get for the one of food drinks, which will be 40% of 1 point what? 40% of what? 1.8. Right? That is 40% of what? 1 point what? 8. Equity beta. Now we go back. We now say, oh, 40%, right? 0.4 times 1 point what? 1.8. Now, don't forget that you already make this the subject of the formula to be X because you are looking for equity beta. You are looking for equity beta for cement. Class, this 1.2 given to you in the question is for both cement and food packaging. Right? And you are given that 60% of it will be attributable to what? Cement. 60% of what? Make X. Now, the one of food packaging, it states that food packaging has equity beta higher, 1.8, which means that it is not even that 1.8 is for food packaging because it is higher. So, which means that 40% of it will give you the equity beta for what? For food cage. Class. Now, 1.2 equals to 0.6x, right? 0.6x plus, please multiply 0.4 times 1.8. What do you have?
0.72.
0.72, right? 0.72. Then you make this subject of the formula 1.2 minus 0.72 equals to 0.6x, right? So what do we have, class? Quickly.
0.8.
0.8.
0.48. 0.48 is equal to
0.48 equals to
0.60x.
0.6. So you divide both sides by 0.6. So therefore, x equals to what, class? Which is the equity
1.25.
beta for cement. What is the equity beta for cement? Quickly.
0.25.
0.8.
You say
0.8.
0.8, right? This is what? Equity beta. Equity beta for what? For cement. That is what we will now use from this formula here. That is what we will now use for the equity beta for cement, because we want to look for the cement, right? That is what we use for the equity beta. BE class, BE class. So that is what we use for cement, 0.8. So you can unmute your mic and ask your question before we continue, please. So I think someone wants to ask question. I said, let me finish. I don't know if the person is still available to ask question. Okay, Desmond, unmute your mic quickly.
Okay, good evening, class. No, I
Yeah,
just
good
wanted to
evening.
tell you that I'm not able to view your this thing, your presentation. I'm not seeing it. I don't know
Oh,
why.
please, others, please confirm if you can see my screen. Please confirm.
We
You
can
can
see
see?
you.
Okay. Yeah, it could be your network. Yeah, it could be your network. I will just advise, probably you log out, you log in again, check your network,
Okay,
please.
thank you.
Yes, log out and log in. Thank you, Isaiah. Thank you. Right. So okay. So now, class, are we still together? You can see that how we dissect this is very simple, right? SFM is very simple. Understand that's why I said when you read the requirement, right, class, you just read that required, right? It gives you 50%. It shows that you've already solved 50% of the question. That requirement you just read, right? It shows that you already capture 50% of that question. The next thing that should come to your mind is that which topic is this? Is this adjusted present value? Oh, is it valuation of a business? Oh, is it? So the next thing after that is the steps. Don't forget, I have I have I have steps to solve all questions in SFM. So master it. You can't master it without solving questions. Class, it is not a rocket what science. You must practice something. You must do something and send. Let's see what you are doing. Now, if this is established, the next thing is to plot our formula. Now, before that, we need to get our value of equity and value of debt quickly. Usually for the proxy company, we normally use gearing, right? The level of gearing. Now let's check what is the level of gearing given to us in this question. I may not complete this question, but I want you to, we have done, this is the most difficult part of it. This thing is the most difficult. Any other thing is increase and decrease, right? So the gearing for the proxy company, you can see is debt to equity ratio of 40. Can you see it? Of what? Of 40. So quickly, we can bring it down and say debt to equity is equals to what? Is equals to 40, right? Is equals to 40. So which means that value of debt is equals to 40, 0.4. Value of equity, right, equals to what? 0.4, 100%, which is 100 plus. And this is how it works. Now, what of tax? Now, we quickly go back there and check what is the tax rate for the proxy company. Now, you can see it is part of your assumption that you will state. It is part of your what assumption. You can see that the tax rate for the proxy company is not given. So you can use the one of the main company here of 25%. It's part of your what assumption. They say state your assumption. Now, you will now go to this number 2 and state it that, oh, it was assumed that the tax rate of 25%, right, of the main company is used for what? For the proxy company. You just state your assumption, you do what? You move on. Take your 3 marks and move on, class. Now, just use 25%, right? 25%, 25%, right? So now we can now plot all these variables now, right? We can now plot all these variables, right? All these variables, right? Now, very simple. Now, let's plot it here. Oh, I need to shift this down. Okay. Now, let's go. BA, how many percent do we have here? Let me check. Okay, this is 9. This is 33. It's fine. Okay, BA. Now, BE for the proxy company. What is our BE that we calculate just now? Our BE is 0.8. 0.8 times VE. What is our VE? Is 100 divided by VE. What is our VE? Is 100 plus VD. What is VD? 0.4. Open brackets. 1 minus tax rate. 0.25 plus, since better debt is given, I'm supposed to include it there. Better debt, BD equals to, let me check the better debt given to us for the POSI company. For the POSI company, better debt is
0.4.
0.4. Thank you. God bless you. 0.4. Thank you for that. 0.4. So we quickly move our formula. Close the bracket, plus better debt is 0.4 times value of debt. The value of debt, right? Let's go down. The value of debt is 0.4. Is 0.4. 0.4. Open bracket, 1 minus, what is the tax rate? 0.25. Close the brackets. Please, I just need final figure here. VE is 100 plus VD is 0.4. Open the brackets. 1 minus tax rate, 0.25. So please give me a final figure. What is your BA? So I will move to the next step.
0.71.
That is the final answer.
0.71.
0.71. God bless you. 0.71. So what is the next step? The next step is to do what?
To reject the company
Okay.
information.
Okay, thank you. That is step 3. Right? Step 3. So you regear by including the company financial risk, right? Financial risk. Let me copy my formula. I have it already. So you move on to this. Yeah. This should be 3. Right. So don't forget, class, don't forget that this better debt is for the main company. This BD is for the main company. Oh. Now, let's do, what is the level of gearing? What is the level of gearing for the main company? Is still debt to equity. We need to confirm what is the debt to equity ratio. Let's quickly go back and check. Okay, the debt to equity ratio here is 30%. You can see for the main company, right, class? You can see it for the main company, right? Okay. So is how many percent, sir? What is how many percent? 30%, right? 30%, right? 30%. Value of debt equals to 30. Value of equity equals to 100. Beta debt of the main company is not given. This will be 0, right? The beta debt of the main company is not given, which is 0. Okay, call ends in 4 minutes. Oh, thank you so much for that. Thank you so much. Thank you. Exclusive.
Sir, please, this capital structure for the main company, is it that one they said the new project is going to move AKPLC to 30% gearing?
That is it now. Is there any other one that we use? That is what we use. It's for AK because of
Okay.
the new project, it will change. So let me quickly create another link so that I can complete this question. This any other part of this question is very simple, right? This is just the most difficult part of it. That's for you to get that equity better. And any other part, just do your increment, get your whether it is viable or not, then we'll move ahead. So let me quickly create another link.